Ben, my notes tell me that you have at least 17 years experience in capital markets, roughly at about the same time that the 2-year break-even was above 3%. Do you think inflation trends these last 15 years that have kept things low, is that changing right now, and how do you invest around that, if indeed they are changing?
I need to update my notes. It's been a few more years than that now. But in terms of the inflation trend, we subscribe to the transitory school of thought, I think, in the round. So transitory, of course, is a very interesting word. If you look it up in the dictionary, it means not permanent. So theoretically, any length of time can be transitory. And I think policymakers are benefiting from that kind of ambiguity around the word. I think it's an intelligent use of the word to give the Fed and other policymakers some space to see what is going on, because I think we all need to admit that it's particularly confusing to disaggregate how much of the inflationary impulse at the moment is genuinely short-term to do with the demand activity restart and supply bottlenecks versus how much of it is more persistent. For us at the BlackRock Investment Institute, we are much more of the view that this is a demand-related inflation short-term surprise that the Fed can and indeed will look through. And therefore, that leads us to believe that the Fed is going to be much slower to hike and will then be much shallower than the market is currently implying.
And looking at the price action across assets, whether that's commodities, crypto, cyclicals, or closing your eyes, Ben, what's the best hedge against inflation right now?
So look, for us, for quite a long time, we've had a clear preference for real assets and a less preference for nominal assets. And I still think that's the right setup. So we are strategically overweight equities, private markets, tips, all, of course, we're aspiring to find real yield in a world where that's hard to come by. So for us, that's the paradigm which is going to continue. The combination of a fairly robust activity restart, spreading out as I'm sure slower than we would all like, but it is spreading out the activity restart from US, UK, Europe into other parts of the world. That combined with still a very supportive Fed, as we call it, the new nominal, this framing of the Fed erring on the side of, I guess, pro-growth, pro-employment, diverse and inclusive growth, and so forth. That combination is just quite constructive. So we get it, we read the papers, we observe S&P at or around all-time highs. But given that combination we think is going to persist, we would persist with the overweight, moderately pro-risk stance, including critically, of course, global equities.
Yeah, okay, well, Ben, if you're still in the transitory camp and you still think that the markets are kind of going on overdrive when it comes to pricing in any kind of rate hikes for next year, I'm just wondering, where do you think U.S. 10-year yields are going to go? Is it more towards 1.4%? We're talking 1.8%? What's your forecast?
Yeah, a bit higher. So we think yields are going to go higher. So I guess I'll answer the question and say 1.8% for a couple of reasons. Firstly, I think clearly we are having a nominal GDP resurgence, and we are having the large buyer, the Fed, step away to some degree with the process called tapering. Tapering for us seems completely reasonable. It was a specific, the recent QE was a specific medicine for the specific problem of markets seizing up back in March, April 2020, right at the acute phase of the arrival, I guess, of the virus. It certainly looks like, we're all hoping, it looks like the pandemic is receding, at least in the US, and therefore removing some of the medicine we think kind of makes complete sense. But for us, that does not necessarily lead to a rate hike thereafter very fast. So again, we think, and indeed you've seen ECB Chief Economist Lane, a couple of Fed speakers over the last few days, I think try and get that message across that tapering and tightening are not the same thing. And it's quite important to disaggregate them as we think about markets.